All right, guys. I have 10 o'clock. Thank you so much for joining. Before we get started with today's workshop on how to vet a deal in 10 simple steps, would somebody hop into the chat box and confirm that you can hear me and see my screen? Can you guys hear me and see me?
Yep.
Awesome. Thank you so much for that feedback there. Okay. For the presentation, I'm going to put everybody on mute. So in that case, I want you to find your chat box, and if you have a question pop up, don't hold on to the question until the end with until we get into the deal analysis piece or to the Q&A section. I want you guys going to the chat box, jotting your questions down. That way I can answer them in the appropriate time, but most importantly, so you don't lose track of them. Okay, so these sessions are for you to get your questions answered. All right, so thank you for joining me on this Friday morning. We are going to continue our workshop series on how to get started as a passive investor. And today we're going to focus on how to vet the deal. So just to kind of recap where we're at and what we're going to cover today, we're going to learn about recap the 3 things that you can control when investing to protect your money. We're also going to understand what to look for when you review an investment summary. I don't know about you. I mean, when I get an 80-page document, it's just like, where on earth do I even start? What numbers do I need to look at to understand if this is a good deal? And then lastly, we're going to go through a frame structure on how to understand if a deal is a good deal in under 10 minutes. Okay. Now, just to couch this, the structure I'm going to show you doesn't mean it's all the due diligence you should do, but it's a good checklist for you to start with, to start asking some great questions of the sponsors, but also understand if you want to throw your hat in the ring, for the investment, to participate in the investment and get all the legal paperwork. All right. So these workshops, if this is your first workshop, these workshops are for, for people who have ever experienced something like this, like, you tried syndications, but you just got cold feet. You have invested in syndication before, but then all of a sudden you kind of realize, I'm not sure if I really did this right. Maybe you made a mistake. Or you want to invest in a syndication, but you just feel so overwhelmed by all the information that's out there. And I totally understand where you're coming from, because one of the things that really overwhelmed me when I first started investing in syndications was this big, huge investment summary. Where do I even start with it? So if this is your first webinar that you're joining, I want to debunk one of the biggest myths that we have, that I hear quite often from investors that want to get into real estate syndications, is that they feel like they have no control when they invest. And while yes, it's not like single family investing, you don't have the day-to-day operational control of the asset, you do have an immense amount of control. And I'll recap those 3 areas where you have an immense amount of control and the 4 ways that you can protect your money that we went over in our last webinar. But before I dive into that, if you guys are if we haven't met each other before, my name is Whitney Elkins Hutton. I'm the Director of Investor Relations and Operations here at Goodegg Investment. And here's my goofy family. This is us standing on top of the Coba Pyramid in Mexico back in January, our last big trip out of the country. Now, I hope to take many more trips like this, in the future. But this is really the kind of the epitome of why I got into syndication, real estate in general, but syndication more specifically. So if we haven't met before and you don't know my story, I started off in real estate in 2002 doing house hacking and live-in flipping, and tackled a few projects prior to meeting my husband, and where we continued our own live-in flipping projects moving forward until about 2016. through this time, we had some ups, we had some downs. We made a lot of money. We went sideways on a couple of projects. But what we realized was when we were doing all these live-in flips and house taxes that we had another job. We were earning piles of money, but we weren't earning a stable income, passive income from it. So we kind of paused our live-in flipping investing around 2010. I decided to finish up school. We started our family a few years later, and then come about 2016, we realized that my husband, who works for the government, that his benefits just were not in his control. It did not matter who was in charge of the House and Congress and Senate, who was in the White House. It just didn't matter that his benefits package, which we were kind of putting our entire retirement plan, building it around, it just wasn't within our control. So we decided that we needed to take back that control. And, we had great success in real estate, but we transitioned into the rental real estate side. Fast forward a few years later, we had over 30 properties under our belt. Again, we had started getting back into flipping to build up more capital. And I wanted to step back and spend more time with our daughter at home. And what I realized with those 30 properties is that I had replaced my income. We hadn't quite gotten to my husband's, but he wanted to have the same freedom that I had. And when I did that kind of mental gymnastics in my head, I was like, okay, I have 30 properties right now. We need to get to about 80 to cover all of his benefits. Just doing that through single family houses just wasn't going to get us there. So we dove into putting together our own multifamily syndications. And that's where I met Annie and Julie. And fast forward a couple years later, through partnering with Annie and Julie, we've knocked out 24 deals. We now have over 6,000 multifamily units and $700 million under management in our portfolio. But what the coolest thing is I get to work on a day-to-day basis with the coolest pool of investors. We have over 600 verified investors in our network, and this is constantly growing on a daily basis. And over 40% of our investors repeat. This last year has been a total wild ride for us here at Goodegg. We've been able to put out a book, start a podcast. We've started our own real estate accelerator course, but we've also been able to travel to majority of our properties this past year and meet all of our wonderful teams in the different markets that we're in. So this is just kind of a quick snapshot. But enough about me. You're not here about me. You're here for you. So let's do a quick recap of what we covered in the first workshop. Now, I encourage you to review that information because we dove deep on some of these topics. But I just want to do a quick recap so you can kind of catch up where we are today. So in the last workshop, we talked about how you can have control when investing in real estate syndications. Okay. Now I wrapped up the workshop with our 4 tenets of conservative investing. So when you're looking to invest in real estate, and this is our investment philosophy here at Goodegg, is that we focus on these 4 core tenets. We, number one, are here to serve you and to preserve capital. All right. So we want to understand that we're working with an operator that's going to go by Warren Buffett's number one rule of investing, which is don't lose money. And if you guys don't know rule number two is see rule number 1. Number 2, we invest for cash flow. Okay. So we don't get into development deals here at Goodegg Investments. That's just not our forte. We believe in creating a stable monthly and quarterly cash flow for our investors, so you guys can actually have stability within your lives and then move forward to go do other great projects, step into your life's purpose. Okay. Maybe even spend time with family and friends. Essentially have control of your time. Okay. And be able to make that choice. Number 3 of our core tenets here at Goodegg for investing is appreciation. Okay. So way we do this is that we're looking to affect that net operating income on the property. Okay. We're running it like a commercial business. How can we increase the income, decrease the expenses, and add additional streams of income in order to push the value on the property? And then lastly, we invest in multifamily syndication for tax benefits. There are some amazing tax benefits. If you're in single family investing, very true, you have depreciation there that you can trigger. But the cool thing that we can do with multifamily units, especially when we have a level of scale of 150 units or more, is we can hire that engineer in there to go in there and do a cost segregation analysis and really accelerate the depreciation to the first 5 years of the project. Okay, that allows us to rack up some really cool, paper losses for our investors, keeping your income tax rate, and then maybe you can use that depending on your tax situation in other areas to offset other income and keep it tax free. We also covered the three secrets. Okay, so when I talk to investors on a daily basis, I hear, I've always wanted to get into syndications, but I really feel like I lose some sort of control over the investment. And especially if you're transitioning from single family investing, I totally understand. That's kind of how I felt too. Single family investing, my mindset was wrapped around on how great the deal was it in a good market, and then could I place it with a good property manager? How I encourage people to think about it when they come into syndication investing is to flip that on its head, right? You are now investing in the I quadrant, okay? If you're familiar with Robert Kiyosaki's cash flow quadrant, we're now investing in a business, okay, a commercial business. So we want to make sure that we're choosing an amazing operator to work with, that we're in a growth market, and that we're going to get into the deal, okay? So those are the three areas of control that you have as an investor, okay? You get to choose the operator that you work with, you get to choose the market that you're going to be in, and then you get to choose the deal that you participate in, okay? And that gives you quite a bit of control there. All right, so it's really in this area, secret number 3, that we're going to kind of like expand on now today. So we're going to focus on the deal. And how do we get this information? Well, when you participate, I can tell you how our systems work here at Goodegg. When you become a verified investor, and if you aren't on our deal flow list already, after this call, shoot me an email. Okay, I'll give you my contact information, and I'll collect a little bit of information from you. Then we can set up a call. It's really important for us that we actually have to have a one-on-one call with you in order to be able to share deals, okay? So I don't know if you guys are familiar with the Securities and Exchange Commission, but we operate under 506B, primarily under the Regulation D with the Securities Exchange Commission. And 506B means we have to have a prior relationship with our investors. And also, we just talked about in secret number 1, you want to partner with an amazing operator. So you want to get to know, love, and trust them. So the first step for us is to hop on that call. And I'll recap more on how to schedule that here at the end of our presentation. But once we get you all verified after our call together, we get you all verified, then we can put you on our deal list. And from there, we can share the investment summary with you, okay? And what I'm going to go over today, applies to nearly any investment that you're reviewing, okay? So when you look at an investment summary, here are the 5 things that you want to find in the investment summary and pull out in your quick overview and your deeper dive due diligence. 1, the executive summary, okay? The executive summary, I'm going to show you what it looks like here in a second. That is going to show us the different returns, a very high level 30,000 foot view of the plan for the project. It'll give you a quick snapshot of the loan, and then also a quick snapshot of the deal structure. Okay, so again, that's exactly what it is. It's a 1-page summary of the project. Part number 2 that we want to find, the investment offering section. Now that might be titled a little differently, deal to deal, but it's going to be either investment offering or something like investment highlights. Okay, now this is a recap of why the operator thinks it's a good deal. All right, so one of the value adds that we do here at Goodegg for you is that we vet all the different sponsors for you, we vet the market for you, and then we also vet the deal for you before we put it out. Now, that said, I would never, 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 never tell you not to do your own due diligence. Okay, so I want to make sure that you guys are actually feel very comfortable digging through this, asking questions, and actually finding that information for yourself. So the investment offerings, this is where we're telling you why we believe it's a good deal. Okay. Then, 3, 4, and 5, we're going to get more into kind of the tactical parts of the investment summary. So in the third part, the property overview section, this is kind of the chapter of the book where we're going to go over like the grounds map. We're going to show you the different unit mixtures, the different amenities that already exist on the property, and how we're going to change that all up in our value add process. The fourth part is the financial analysis. Okay, in the financial analysis, we're actually going to deep dive into the debt structure, the return on investment, the different cash flows that you can expect, our pro forma projections. Also in this section, this is where when we go through our checklist, I'm going to ask you to pull out rent comps and sales comps. It's in this section that you're going to find those rental comps and sales comps. Also in the financial analysis section, you want to take a look at what we call a sensitivity analysis. So sensitivity analysis is a fancy word for saying, did the operator actually run the numbers for different situations? Okay, have they stress tested rents? Have they stress tested the cap rate, floating up or coming down under different market conditions? And then the last piece is the market overview. And the market overview is going to go over the MSA level, the metropolitan service area data. It's going to go over the submarket area, kind of where the surrounding neighborhood of where that asset is. And then you can actually, get into some mid-level data of just like the city data. Sometimes that's included as well. And when you, on our last session, when we were diving through, how to underwrite a market, it's that data, that structure that we went over on how to underwrite a market that you want to actually double check on the market overview and ask any questions of an operator. All right, so those are the 5 sections of the investment summary. All right, and so I just kind of helped you kind of put the different pieces in place. So whenever you're going through this 5-minute checklist, you know where to look for this information. All right, so let's take a look. What is our 5-minute checklist? All right, so again, I'm pulling, recapping from our first session, our 5-minute checklist is that we're actually looking for 10 pieces of information. And I'm going to throw in a couple others on top of this just for giggles that we'll take a look at as well. So in our 5-minute checklist, we want to understand what is the asset in the asset class. Is it A, B, C, or D? How many units is the property? What is the equity multiple on the property? And that equity multiple means over the life of the pro forma. So if I have a pro forma, a business plan, and I'm telling you that it's going to go 5 years, over that 5-year period, if I say an investor invested $100,000 with me, if I tell them it's a 2x equity multiple, I am telling them that I'm going to take their $100,000 and turn it into I'm projecting that I'm going to turn it into $200,000. So that would be a 2x multiple. Just for example's sake, if we said that it was a 1.5x multiple, then I'd be taking that $100,000 and turning it into $150,000. Okay, so that's kind of how that works. And that's between cash flow and the equity on the back end of the investment upon sale. I'm also going to look for the internal rate of return. I'm going to look for what type of lending it is. Is the interest rate fixed? Okay, and is it interest only? And I want to know for how long. Okay, we're looking at the debt there. What is the reversion cap rate on the property? And just to kind of recap, a reversion cap rate means that it also ties into that sensitivity analysis, has the operator underwritten the property for the cap rate to go up over time, meaning the market's getting worse, not better. Okay, we always assume a reversion cap rate. Okay, and I have seen some performance where the cap rate stays neutral over a 5-year period, and sometimes where they say it's coming down or the market's getting better. We don't know that. So we always underwrite our projects for market conditions to be worse upon exit. And if they're better, you're going to love us. All right, number 8. Are there multiple comps higher than the subject property? Now, this is also on rents and sales. Okay, so we'll take a look at that. And then what is the projected rent growth on the property? And what is the projected vacancy? For both of these, I would keep these to 3%. That's kind of the target we're looking for. So rental growth, we might be able to get 4 or 5% rental growth with our rehabs and adding additional streams of income to the property. But here's the thing, is I don't know if that's going to be sustained over time. So I just want to make sure the pro forma isn't too aggressive to achieve the returns. On the projected vacancy, I want to make sure, again, I want to keep that at about 3%, and that's what I want to see. But I don't want my operator to say, oh, all of a sudden vacancy is going to go down to 0 or 1%. That's unrealistic. Okay, so we want to see the vacancy be underwritten at like 3, 4, or 5%, somewhere in there. All right, now I gave you 10 points here, but how do you grade these 10 points? Right? I mean, what makes it good? What makes it bad? What makes, or what makes you take pause and ask further questions? So let's pause for a second. Let's switch up to the screen here. This is a little snapshot, okay? Now this is a tool that I have used and we've used internally to underwrite some of our deals personally, okay? So if, again, number 1, the asset class. For me, the way I like underwriting my deals, an ideal deal for me is I want to get into a solid B class or maybe an upper level C. All right. It's still good if it's a stabilized A, like that. This is my parameters. This is what I want to see. Maybe, you know, if it's a stabilized A class, I'm okay with that. For me, I don't want to invest in any D properties. No way, no how. That's just not my area of expertise. I don't want to get into that. But that's how I orient to the type of deal I'm looking for. For me, I want to make sure that my unit mixtures are 100 and above because I want to make sure there's some sort of scale to the property, okay, that we can have full-time staff on there. I'm not really interested in this kind of mom and pop area of multifamily investing that's 50 units or smaller. That's just not where I'm at. I might look at a properties between 50 and 100 units, okay, but I'd have to vet further the rest of the business plan. For me, I want an equity multiple on my properties closer to 2. 1.75 still good. If it's 1.5 or lower, I'm going to ask further. I'm going to try to, it depends on what the business plan is. An internal rate of return, my target is 16%. I would probably still consider a deal if it's between 14 and 15. And if it's lower than 13%, I might consider something else. Now, here's the thing. I'll go through each of these points, but how I'm grading this is that I might check, 7 of these boxes, 10 boxes might be ideal, a couple might be good, and 1 I might need to inquire further. Now, that doesn't mean that I won't do the deal. It just means that's just kind of where I'm assessing on what is negotiable for me and what's not negotiable. All right, type of loan. This is really important right now in our current market. Type of loan, really the only thing that's floating right now is Fannie Mae and Freddie Mac, okay? The non-recourse agency debt. Is there non-recourse bank loan or private money? That's also still a good option. If the loan's recourse or it's a bridge loan, I'm gonna ask further, okay, on what's going on and what the actual exit and business plan is. Okay, the interest rate. I like to have my interest rate fixed for at least the hold period, if not longer, right? It gives me more flexibility, or gives the operators more flexibility to execute the business plan. So the pro forma of the business hold time is projected to be about 5 years. I want to make sure the debt's at least 5 years, if not 7 to 10. Okay. If it's less than 5 years, if the rate's fixed for less than 5 years, and I exceed that rate lock, can I buy down the rate? Okay, can I actually lock it, lock it further, longer than 5 years? All right, reversion cap rate, we talked about that a little bit. I like projects where the reversion cap rate assumes at least 10 basis points for every year of hold. So if my hold was actually 7 years, I want to see this at 0.7. Okay. If the hold was 10 years, I'd want to see this at a 1% exit cap rate. Market rental comps. Are there multiple properties that actually have sold higher than the subject property? Are we the top dog right now at the sale? We don't want to be there. Okay, we want to at least have one higher than us, or multiple projects higher. If you're doing value add investing, we want to make sure that there's a few properties higher than us. Okay, that gives us room to grow and to be competitive. And then we talked about this rental growth, conservative at less than 3%, 3 to 4%, if the market will allow it, is also still good. And then we talked about the projected vacancy. Okay, conservative at least 10% per year. Okay, more often than not, you're going to see it underwritten somewhere between 5 to 10% per year on projected vacancy. All right, I'm going to pause right here. If you have a question, when you go to the chat box, make sure to type in your question. You can also unmute your mic. We'll test this out, ask your question, and then we'll dive into taking a look at a couple of investment summaries. Does anybody have any questions currently right now? All right. So be sure to, don't hold on to your questions, drop them into the chat box, but let's take a look at an investment summary. So here is our project that we closed on last fall, Carrington and Briar Creek in Greenville, South Carolina, or excuse me, Raleigh, North Carolina, actually. And again, let's see how long, this is a 44-page investment summary. So it can be kind of long and wielding. So let's take a look where all this information is. So as I'm scrolling through here, I'll answer. A question came in, is the vacancy economic plus physical? Great question. We are more concerned with the economic vacancy on the property, okay? Especially right now. That's what I would focus on, is the economic vacancy of the property, because you can still have physical occupancy and economic vacancy. What states are we looking in right now? Great question. Our current portfolios in Texas, Florida, and the Carolinas for our B-class value add properties. I think the market over the next, in Q3, Q4 into Q1 next year, we're kind of broadening our horizons, so to speak, and taking a look at other markets as well, because I think we're going to see some deals popping online. But more importantly, we're looking for growth markets. Okay, going back to our first webinar, we want to make sure that jobs are growing, incomes are growing, there's great job diversity. Our businesses are moving their headquarters there, so we want to stack all those investing cards in our favor. And there's other parameters as well, but those are some high level parameters. All right, so here's our table of contents. Here's what the investment summary looks like on a project like this. Okay, so you can see here we've got our cap rate. Let's go through the offering summary. You can see that we have our entrance cap rate of 4.86, and then we've got, this is a 5-year hold on this property, and we got a 5.36 at reversion cap rate. So again, hitting that 50 or 10 basis points per year, 50 basis points overall. Debt service coverage ratio. I like seeing a debt service coverage ratio of at least 1.2. Okay, that would be 80% loan to value. I'm far more comfortable at a 70% loan to value. So this would, debt service coverage, meaning this is 30%. We have 30% down on the property. All right, hold time 5 years. All right. That's just a number for you to look at. There's really no right or wrong to that. It's just that if you have a 5-year hold time, you want to make sure that your reversion cap rate is at least a 0.5% spread. All right, here's my equity multiple, okay, 1.98. So that means if I'm investing $100,000 underwritten in the pro forma, I'm projecting in 5 years to between cash flow and the equity on the back end for my investment to yield $200,000 total. Okay, I get my $100,000 original capital back, and then I get an additional $100,000. All right, that's pretty cool returns. This is my average cash on cash returns. Okay, so again, this is average over the 5-year hold period. All right, I got my internal rate of return of 16.2%. So between my cash flow and my back end equity, I'm looking at my internal rate of return per year to be 16.2. I find this number far more valuable to evaluate above the average annual rate of return. So this is the one where I'm looking to target 16% or more on. Okay. Now again, 13 to 15 for a stabilized A property, potentially really good right now. I would also say if somebody is putting out a deal in this current market and it's they're projecting 13 to 15% in this current market, that might also be something to consider as well. So again, this gives me some high levels. I understand where it is. I got 250 units. It's a 2003 vintage. Okay, so it's a B class. But I don't really have all the information I need to probably determine if this is a good deal or not. So if we're going back to our checklist, this is a B class property, 100 units or more. I've got an equity multiple near 2, internal rate of return at 16%, which is pretty good. I don't know these pieces about my debt yet. My reversion cap rate is at 0.5%, so I can check that. And I don't know my market comps or my rental growth or my vacancy. All right. So again, this is a little bit fleshing out things about the executive summary. I'm also looking here, right here, of what the back end split is and what the preferred return is. Now I want to demystify something about the preferred return, because I know when I talk to a lot of investors, they're like, oh, I'm looking for 8% or 9% pref or cash on cash. So if you notice here, my cash on cash is 8.1%, but my pref is 7. So what I'm looking to do is I'm giving my investors the first 7% before any splits are taken. Now, as my cash grows and blends out over time, I'm going to be able to distribute closer to the 8%. So you might also see a 7% preferred return in year 1. They're actually they're projecting 8% cash flow. What the operator then is doing is giving 7% preferred return, allowing the investment to perform for a year, and then they're evaluating at the end of the year if they can distribute above the 7% cash flow. So 7% is about right where we are in this market today. Okay, that's coming down as a function of cap rates. As cap rates continue to fall, we expect to see that preferred return fall. But also when it floats up the other direction, we would also want to see that float up higher as well. So great question that came in. Is year 5% correct? Down here. It is. And you want to know why? Because this is when we're selling the property. Okay, so this takes into account the annual percent return in year 5 would be including the sale of the property. So I know it looks really wonky just to all of a sudden to be like, what, 168% return? But yes, it is correct. I know. All right. So that kind of gives us the high investor overview, but let's start digging into the investor highlights a little bit. Okay. Again, remember this investor highlights section is where me as the general partner is telling you why I love this deal. Okay. And it's for you as the investor to kind of vet this all out and see if you agree. All right. So again, I got my unit count, my year that's built. This is very important. Current occupancy on the property. It's 97%. That's awesome. Okay. We shoot for deals where the current occupancy is like 87, 89% or higher. We love for it to be in the 90s. Now, remember, I told you I'm giving you 10 things on your checklist. I'm going to add an 11th right now, especially in this COVID environment. Ask the operator what the break-even occupancy is on the property. Oh, now, what do I mean by break-even occupancy? How low could the occupancy go on that property and you still pay all the bills and not have to do any capital calls to the investor? We are closing on one today where the break-even current occupancy is over 97%, and the break-even occupancy is down to 55%, which is just insane. That's amazing. Our usual target for break-even occupancy is between 60 to 65%, meaning that our occupancy could probably fall 25 to 30%. And we can still cover all the bills on the property with the current incomes that are coming in place and not have to tap into any reserves or make any capital calls. So that's very important because, if you're comparing operator to operator, not all operators underwrite that conservatively. Okay, so you make sure to ask that question. Again, this will just kind of give you a high level overview. But, even though I have an average square foot of 1102 per unit, we don't know how many units. Okay, we don't know what the unit mixture is. We still don't know a lot of data about our property. So we got to dive deeper. Okay. Again, the investment highlights will also go over what the business plan is. Okay, what am I projecting as far as value add to this project? What are we going to be doing with the CapEx reserves? What do I love about this project that's going to give me that lift and upside? So on this particular property, the question came in, what was the break-even occupancy? I should have brought the exact number, but I can guarantee you it was between 60 to 65% on this particular property. Okay, that's our underwriting criteria. So don't quote me, but I'm thinking the break-even on this was about 61 to 62. This was one of our lower break-even occupancy properties. All right, so again, targeted capital infusion. This is where we dive deeper on how we're going to use the CapEx money to push to market rents. Okay. Remember, we're pulling 3 levers here of net operating income. How do we get the units to market rents? How do we add additional income to the property? Okay. So again, we have a multi-layer income strategy. We're going to be able to actually rent out the detached garages at a premium. Okay. And then, this is also, again, getting into the further points of why we like the project. Okay. You'll usually see something like this of all the businesses around the subject property area. This is where we're projecting. The question is, this is fantastic. This unit is close to all these businesses in the triangle. The question I would always ask an operator is, the tenants that actually live here, where are they working? Right? Are they actually working in this area? And so the operator can actually do what they call a lease audit and figure out where the employers of the tenants actually are. And on this particular property, we are pulling very heavily from this research triangle area. All right, this gives you kind of a breakdown area over, what does the area look like? Businesses that are around the area. Again, here's Carrington and Briar Creek. What are kind of your distance outlays here? Here's the Raleigh-Durham Airport. We're pretty close to the airport, 5 miles away. Okay, so not so close that it's disturbing. Yeah, so this is just kind of gives you like a little bit of an outlay. Also, downtown here is only 14 miles away. All right. So again, more about the job area, the employers. Okay, so let's take a look at the property overview. This is where, again, we can confirm our unit mixture, the year built. Now we actually get to see the actual units of the property. Okay. We also can look here, are the utilities paid by the tenant or the resident or by the owners? Okay, so we want to see that utilities are paid by the resident. If they're not, is that part of the business plan to move the utilities back to the resident? Okay, so just because we see that the resident isn't paying the utilities, maybe that's part of the business plan to do what we call a RUBS, where we're pushing those utilities back to the tenant. Okay, we're looking at the different amenities on the property. Is this a place where you would want to live? Okay, unit features. We often find that washer and dryers, covered parking, garages, those are all great things that we can add to properties, even broadband internet and valet trash. Those are some great areas for us to add additional features to the property, even storage lockers in order to increase the income on the property. Okay. Those are just like the breakdown in the bedrooms. Now here is another thing. You also want to double check the kind of the construction. Okay, we'll get into the budget here in a second, but here's the current unit at Carrington. And then this is how we're actually going to rehab it, is something like this. All right. Now, you know, to take something like this, you know, on the left to make it look like what's on the unit on the right, that's about $3,000 to $5,000 to do. Okay. And so we want to make sure that when you review the budget, that's in line with that expectation. Here are the floor plans. I always like looking at the unit mixture and make sure that there's a good unit count mixture, and that there's at least a few 3-3 units in there, or 3-2 or 3-3 units. So 3-bedroom, 3-bath, or 3-bedroom, 2-bath units. Okay, this gives you a nice unit mixture. As tenants start to have families, they can actually move up to a larger unit, and you don't necessarily lose your tenants. Okay. You know, so I take care to make sure that there's a wide range of units. All right, the layout, site map. Now we're digging into the financial analysis. And I know some questions that come in. I will go through everything, you know, here in a second, but let's continue to move through the underwriting here. So here's where I'm looking at the loan. Okay, so we've got, we're gonna make 36 months of interest payment, okay, a 5-year term. We are actually, this was an adjustable rate mortgage, but we're purchasing an interest rate cap to mitigate risk. Okay, amortized over 30 years, and then there's no prepayment penalty. That's really good to make sure there's no prepayment penalty. We can actually sell the property at any point in time and not have to pay what we call the yield on the rate, the spread to the lender. That's just a fancy way where the lender just guarantees that they're going to get some sort of debt payment over a longer period of time. Now, so if we flip back to our underwriting checklist, okay, is the loan interest rate locked for 7 to 10 year period? No, but we can lock it in for 5. Okay, even though our current rate is for 3 years, we can actually lock in this debt for 5. So that's very important. So this is still good. All right. This is, we'll dive in here further. This is a non-recourse loan. I know that, but let's find that. Here we go. I believe it was up in a previous section, but on that, we only do non-recourse loans on our property, but this is a non-recourse loan, so I can check that box. All right, agency debt here. Okay, check that for the interest rate. We already can check our reversion cap rate, and then now we just got to underwrite the last 3 pieces. All right. Now this screen shows, again, our cash flow. Okay, year 5 cash flow is actually 9%, but remember we saw that 168.4 on a previous screen. That was overall return to the investor with the sale of the property. But this actually will help you understand what the cash flows look like over time. All right, pro forma projections. All right, this is a fun document to try to pick apart. Okay, we want to see our pro forma over time, okay, our incomes and then our expenses. We want to take a look at these numbers, especially the first year, and compare it to the trailing 12, okay? We don't want to see huge variances here, okay? You know, so, you know, like bad debt, you know, being completely eliminated. Here we're going negative because we're moving it into, usually what we do is we take care of bad debt in a different line item and under potential rent. Okay. Vacancy loss. All right. If all of a sudden, like the operator said, okay, vacancy is 0%, vacancy loss, no way, no how. Okay, that would be a red flag for me. Okay. But again, we want to make sure that the first year isn't too much different from the trailing 12. And trailing 12 just means what the previous owner's actual expenses were for the previous 12 months. Okay, and so this looks all pretty in line. Okay, and then this will show the net operating income on the property, and as you can see, we're scaling up, and that'll increase the value. All right, rental comps. So this is getting in. We want to look at Carrollton and Briar Creek. Here's our 1 unit. We've got several properties that rent out for more than $691. Okay, here's this, our 2.2 is at $1177. We've got several properties that rent out, a couple properties that rent out higher, 3 properties that rent out higher than $1177. And then for the 3.3, we are the close to the top of the market, okay, for the 3.3, because we're the only one with a 3.3 for the top of the market. So that means we would push the top of the market, but as you can see here, we're not the only. Okay, here's Ashley Park at Briar Creek at 1618. So we're still got a good buffer from being the top dog in the area. All right, so we can go back to our checklist. So market comps, okay, we can say multiple higher than the subject property. That's awesome. Okay, and then sales comps. Again, we want to see this as well. We want to make sure that we're not the highest property in the area. As you can see that there's, we fall in line with the comparable, with the sales comps in the area. All right, sensitivity. All right, so this is what we want to kind of pick apart right now. So right now, our sensitivity, we're saying we're exiting at 5.36 cap rate, assuming the market's worse after 5 years. Our internal rate of return is 16.2. If it went up over a full point, this is 1.2 points, my internal rate of return would be 11.6. Okay, so we want to make sure that the operator is actually taking care to look at these numbers. As you can see, if the cap rate actually falls, meaning the value of the property goes up, like if we, we bat a huge home run, then our IRR jumps up to 20%. This is also when we're looking at the break-even occupancy here, okay? You can see here, occupancy down to 65%. We are very close on a break-even occupancy, all right? So that is what we want to take a look at. Like I said, this one I believe was down to like 61 or 62. But as you can see, if many of our units were vacant for whatever reason, then we could still cover the bills, right? And again, the market overview, we talked about the market, how to vet the market, but we want to make sure that jobs are growing, incomes are growing, there's good job diversity of employers in the area. We want to make sure that we have good solid median rents for the area, okay, that rents are actually affordable for the population. We want to make sure that incomes are growing. We want to make sure crime's coming down, vacancies coming down, poverty's coming down. I'll include the link to the workshop number 1 so you guys can get that deep dive information. But this just goes over the market review. And again, I highly suggest that you make sure that those numbers line up. All right, so I got us at 10:50 Mountain Time. Okay. Oh, we looked at the projected rent growth. Okay, this one, the projected rent growth was 3 to 4% actually. So right at 3. So I put it still good. And then vacancy rate. Apologies for that. Let's scroll back up here to our analysis. We would make sure that we're actually counting for vacancy over time and that it's staying in line with our potential rent income. So I don't have a calculator in front of me. So 200, yeah. So vacancy right here, we're projecting close to a 4% vacancy rate between year 2 and year 3. So again, we're hitting right 4 or 5%. We're probably like a tail end 5% right here. All right. All right, so let's start diving into everybody's questions. Minimum investment for a deal for this particular deal was $50,000, and the majority of our deals are $50,000. And distributions start within 45 to 60 days after closing, and it just depends on when we close during the month, okay? And yeah, we can take, we do work with individual investment, entity investment, and IRA, and we deal with wires and checks. It depends. If we're on a very short funding time period, we may only take wires, but we can actually deal with majority type of investments. How do you evaluate value at the time of sale? Also, will we hold if it's not a good time to sell? So this is multifamily investing, or a multifamily unit is a commercial business. So it's going to be your net operating income divided by the market cap rate at the time of sale. So we can control the net operating income by pushing rents, creating operational efficiencies, so lowering our expenses, and then adding additional streams of income. The market cap rate, moves slowly over time. Okay. We like to see it go up. But again, that's why we underwrite it to go, or excuse me, we like to see it to come down. If it goes up, it means that the market's actually getting worse. So if your cap rate goes from that 4.86 to the 5.36, that means the market's getting worse. And so we've increased the value, right? Because we've added all this stuff in the net operating income, but are we going to get to divide it by a 4.86 or a 5.36? We hope the 4.86, but our numbers still work at the 5.3 or even above. All right. If it's just all of a sudden like the market cap rate, the cap rates just have like gone up to 9-10%. I mean, that's just outrageous in my mind right now, but we would hold on until it's a good time to sell. Again, we're focused on the capital preservation, cash flow for our investors, and then, trying to capture that appreciation on the back end. What is the projected expenses over the 5 years? I'm not entirely clear on what you're getting at here, but we can look here at our pro forma, and so we can see what our pro forma is over time. And a pro forma is a projection. All right, this is what, with the best data that we have currently right now in our due diligence period, this is what we're projecting that we can do. Then we get into the real management of the asset, and so these numbers we might be able to beat these numbers, or we might actually break even. And, every once in a while we have surprises that we just have to like kind of flux things around and operate it like a business, adjust. Okay. Bend and adjust in order to get to our return rates. Do investors have access to balance sheets through the life of the investment? Yes. So when we close on an investment, the following month, we do start monthly communication. Okay, we give a high overview of the property and what's happening at the property, and then every quarter we will, send out the trailing 3, 6, 9, or 12 month, depending on where we are in the ownership of the property. Once we've owned it for a year, you'll always have the trailing 12, and then we'll also send out the rent rolls. So, and investors will always have access to that. When is the cutoff for investment on this property? Carrington Briar Creek, this is closed in our portfolio, so we're no longer taking investments on this property. So let's kind of wrap up, because of that perfect segue, Sean, thank you so much, into kind of wrapping up on what my next questions are. So what are the next steps? If you're not already in our Goodegg Investor Club, make sure that you've joined our club. You can do so from our website, or you can just really simply, that invitation that you got for this webinar, hit me an email back, and I can give you the link, and we'll get you applied into our investor club. We just have a few questions to ask. Once you're in the club, we can set up a phone call with you just to kind of get to know you better and your investing goals. That is a requirement, SEC requirement, because we operate under 506B. So if we don't get an application, if we don't set up a call, I can't share deals with you. So if you're interested, make sure to email me back. Let's get you in the club and talk very soon. And then the next step after that was just make sure that you have all your questions answered, and that we can then put you in our deal alert list and start sharing deals with you as they come up. All right. Well, I'm going to back up just a little bit. Did you guys learn something, new today, or were you reminded of at least one thing? Was this useful information for you? If you would, pop over to your chat box and let me know, because I want to make sure that these webinars are for you, to make sure that you fully understand what syndication investment is like, and just how powerful of a vehicle it can be. All right. Now, I know it's very close to time, and I want to be respectful of everybody's time. If you would also go to your chat box, what other topics would you like me to cover? If you would, I'm always looking for ideas. Type in there, let me know what ideas that you guys have, what information you want me to dive in there. The question came in, is there a cost for joining the club, the Goodegg club? At this time, no, we don't have a cost. Okay. Do we ever invest in notes? Personally, I do. I love investing in notes. We don't have a note investment open currently right now. It is something that, we might be looking at offering for our investors in the future, but I have no timeline on that. But notes put you on the other, here's the thing about notes. You want to take, for those of you who are here, I love educating people on just how income comes in, what the difference is. Notes produce active income. I know it's bizarre, even though it seems passive. It gives you ordinary income. So you don't get the tax advantages of real estate. So, but if you have an investment, you can take the losses of one and offset the gains on another. So that's pretty cool. That's a really powerful strategy. All right. Let's see. I got several questions that come in. I will try to take them in order. Let's see. Okay, I think that's something you guys would like me to cover in a future video, would be explaining the payouts. Explaining the structure. Okay, so there's no difference in the payouts between a 50,000 K investor versus a 100,000 K investor. That would only be it's based on your ownership percentage in the single member LLC, or excuse me, single entity LLC. But there is a different, breakdown structure for the GPs and the LPs, and I can definitely dive into that in future webinars about how the deal structure goes. No, thank you so much. Hear about the environmental investments like sustainable housing? Okay, cool. Yeah, we can put that on the list. Deep dive exercise of breaking down the pro forma. Okay, we can put that on the list. All right. Maybe unless you guys would like to hear more about commercial spaces and remote working. Okay, I will try to tackle that. Basics on what you need to do prior to first deal. For example, if the objective is to create cash flow to quit a day job, is there any structure LLC recommended setup? So let me tackle that right here. In order to get into your first deal, really you just want to make sure that you have a very strong financial foundation and good cash reserves, because, syndications carry the same risk as investing in real estate. So on my single family houses, I can have a capital call. The water heater can go out. The roof needs to be replaced. Okay. With the syndication, if for whatever reason the operator has drained the CapEx account and the reserves are getting low, they have to do a capital call to investors to keep the investment going. Now we underwrite where we have all of that raised at the front of the project. So we have two different accounts. We have a CapEx account to execute our business plan, and then we have a reserve account. And we oftentimes carry heavier reserves than our lenders actually require. Okay, so we come in very well capitalized on our projects. Not all operators do that because they want to offer greater returns to their investors, and that's one way they do that, by not having the money all up front. Now, so I got a little off track. So you don't exactly need to have an LLC in place. That was where you need to partner with your CPA and your your lawyer to understand what your tax and legal situation is. For me, I know a lot of people, and myself included, invest through a trust, so I don't have to mess with probate. Like, should something happen to me, those assets just remain intact and they go on to my heirs. That's something to consider. Again, that's just my personal structure. You can, I would just get with your CPA and your legal team and make sure that that's okay. But number one, just make sure that you're really well capitalized, and that you can work through that. If a project has some bumps in the road. Has any of our projects failed? No, none of our projects have failed. Now that said, we've had operators, and this is always a great question to ask operators, is you're hiring your operator in your business. Think of it like you're running a business and you have to have a COO. You want to know that they've handled tough situations and they've been challenged. I would be so scared of somebody who's never handled a tough situation. Like when I'm hiring a property manager, they need to have a plan to have handled an eviction and a nasty one at that. Like, I want to know that. So with for us, like we haven't had any of our projects fail. We have never had to do a capital call to our investors. Now, that's not to say that we haven't had some bumps in the road, where we've had to negotiate, like we had a tree fall in one of our units. Nobody was injured, but we had to mitigate all the insurance claims for that and make sure that we could get keep the property well capitalized and moving forward. And those are all great questions. Just for the efforts of time, we can answer individually on calls. So I'm happy to jump on the phone with anybody that applies through the Goodegg Investor Club, and we can tackle those one by one. All right. I know there's other questions that have come in. I would love to stay on and get those all answered, but I want to make sure that we're being very cognizant of everybody's time. And I'm going to actually stop the screen share. If you want to stay on, I can answer a few more of those questions. But for those of you who need to take off, here is my contact information, Whitney@goodegginvestments.com. Would love to hear from you, and let's talk soon. Thanks so much. All right.